But then I think structural inflation will take over again. So to answer the opportunities question, I'm looking at, the metals and mining sectors. Gold stocks have gotten off to a great start and have historically, gold has performed well after you have a year when the S&P and the bond market are both down in negative territory.
Hello everyone, I'm Giorgio Tavazza and you're watching Avanguardia Investment Media. Today we are joined by Tony Greer, founder of TG Macro. Tony, thanks for being here.
Giorgio, thanks for having me on. I appreciate it.
Nice. So let's jump into it. As we are starting the new year, what is your outlook for financial markets and the economy for 2023?
Well, I always tell people I'm not an economist, right? I'm a trader. So the way I look at it is sort of, so I would start with figuring out what direction I think interest rates are heading and which way I think that they're still going to be heading. And when I look at interest rate charts, Giorgio, from, whatever time frame, it looks to me like the rates are still on their way up. Right, we may have come to a period where they're consolidating a little bit or going up a little bit less at a slower rate. But to me, rates are still going higher, broadly responding to commodity inflation. So that was the story last year. And we saw commodity markets, natural resources, oil services, exploration and production markets all outperform, up some of them 40%, 50%, 60% on the year. And we saw basically technology be the big underperformer last year, right? With all tech stocks getting knocked lower with higher interest rates, et cetera, et cetera. So just because we have turned to a new calendar year, I haven't really changed my view that much, right? My view has changed. My view only changes in as much as the Fed is still going to be addressing inflation. They are addressing inflation now, and they'll probably get some reasonable pullback in the headline data and CPI. But then I think structural inflation will take over again. Because if you look across all commodities, you'll see that we're well below historic inventory average levels across base metals, across oil, gasoline, jet fuel, things like that, and some grains. So it's important, I think, to see that picture as the sort of overall dynamic that's still not going away, right? There are short commodity supplies, low commodity supplies, I should say. We continue to see an attack on supply out of the West, both in the EU and the United States, not allowing any E&P exploration and production companies to expand their drilling platforms and drill for more oil. So with that kind of a view, Giorgio, I think that the economy will probably weaken as a result of the Fed raising rates so much last year. But I think that the inflation is still going to be present, and I think that the Fed is going to have to consistently battle that. So to answer the opportunities question, I'm looking at, the metals and mining sectors. Gold stocks have gotten off to a great start and have historically, gold has performed well after you have a year when the S&P and the bond market are both down in negative territory. So in the 3 and 4 and 5 years following those scenarios, it's usually a good atmosphere for gold. And so that fits with the inflationary story that I kind of see as an overlay for the economy. So I think that's my point. Everybody was looking very seriously and very directly at a recession happening this year and being a very deep recession and the market's selling off into that. And if you ask me, it looks like the market sold off ahead of that last year when we cratered to 3,500 in the S&P and have since, bounced about 500 points off of that low. So that's how I'm looking at things to start out. And we can take, I'll let you drill down into whatever portion of that view that you would like to. I know there's a lot to unpack there.
Yeah, so it seems like you're saying that all these rate hikes that the Fed did in the past, now we're going to see the effects in the next months. And additionally, you're saying that inflation is not cured completely, and that we may see another spike, which may resemble the 1970s. Do you think it's gonna be the scenario going forward, or do you think that this time around is different because the debt levels are so much higher than the 1970s?
Yeah, you can never say that the world is the same as when the last time, these events in the market happened, but you can say that we are set up for a similar scenario, right? I think that that's a really good analog to look at as the early 70s in terms of how the inflation story and markets panned out. We had a big down move in 1969, and that was one of the years that um, stocks and bonds were down both in the same year, right? And then after that, the stock markets rallied out of that, the bond market rallied out of that, and gold rallied sharply for the next several years. Now, that coincided with Nixon taking the United States off the gold standard in 1971 and unpegging the currency. But you had years right after that where gold was up 50, 60, 70%. So we'll see if that's the case. I like having that history on my side. I don't necessarily count on it as being the same exact story or the same exact path, but it seems like we can probably navigate the trades the same kind of way. Where, as you said, what I'm looking for is probably a pullback in headline inflation, and then later on in the year, the structural inflation, those low commodity inventories starts taking over, and we see another rise in energy prices, another rise in food prices to follow that, and then inflation ticks right back up to 8 or 10% or something like this.
Nice. And now, talking about bear markets, all bear markets in history eventually find a bottom. Some investors today might think that the bottom is already in. Other things that we might go towards 3,200 in the S&P. What would you need to see in the markets and the economy to say, okay, I think the bottom is in and we better prepare for a new bull market?
Well, that's a good question, Giorgio. Really good question. I'm a very performance-based analyst, right? In addition to, trying to have a fundamental understanding of why things are happening, I always let the market tell me what it's doing I analyze the closes, every day, every week, every month, every quarter, every year across, the interest rate, the commodity complex, the equity complex. And that's the situation where I would let the chart do the talking and say, it's very nice that the world is expecting the S&P to crash. It's very nice that the world is maybe expecting a very deep and prolonged recession. That's not what the market is saying, right? So if the S&P were to start putting together, it would have to show me by moving, right? But show me by rallying. And so far, it has made a lot. The S&P, I would say, has made some of the right moves for that. What was it, June of last year? Oh no, maybe earlier of last year. Oh no, I guess so. It was October of last year, for that being a good bottom, right? So there's a chance that that's a bottom. If we get back up above the 200-day, which is up above in the S&P at basically 4,080, so about 110 points above where we are now, that would be a huge technical trigger. That would be one thing that says, hey, you have to start thinking about upside rather than the downside if we start clearing these moving averages. I would think that if we continue to see weak economic data and the Fed maybe gives some sense that they're going to pivot away from fighting inflation with high interest rates towards leaving rates where they are, or talking about lowering them again, that might be a signal that you really have to be prepared for a move higher in stocks, right? Giorgio, I feel like the scenario could be the scenario only because, number one, we had a real bubble in negative sentiment when the S&P was down at its lows last fall, right? Everybody and their brother thought that the S&P was going to keep going down. And finally, that's when it found a bottom at 3,600, and we had the 100 handle down and back on one day, and we never broke that low again, right? So it's interesting to know that we had the sentiment bubble, negative sentiment bubble at that low, and coming out of this now, we've got natural resources, which had a great year last year, starting to perform once again this year. So if we get sort of the natural resources side of the equation going, where we see inflation there and in those sectors, you might have to start preparing for the S&P to be sideways to higher, right? I'm still in the camp, though, Giorgio, that big tech and the heaviest weights of the S&P are going to be under pressure. So if they're going to continue to be under pressure because of high interest rates and a lot of inflation, then the market probably struggles to have upside, in my opinion. So it's really difficult to figure out where that balance is, but I still think it comes back to one of the more important, ideas that I had at the beginning of last year, right? At the beginning of last year, with all the sectors set at zero performance, I was saying it's not only is it important to be in energy sectors this year, but more important to be out of tech, right? And so that I wound up being right on both counts, where natural resources were the only performers and technology, had a terrible year. So I feel like it's the same thing again, where it's really important to be in the right sectors and to be out of the way of the right sectors. The things that I think are still going lower, which are all of that technology and that consumer discretionary type of stocks that all had a big bubble into the lockdown and made new highs with the NASDAQ. And now, as you see Apple and Salesforce laying people off, we're clearly on the other side of that bubble. So I still feel like there's a little bit more downside in a lot of those heavy weighted tech stocks. That's what makes it hard for me to get bullish the S&P.
Got it. So going back to the opportunities that you see coming into this new year, as you said, is again the energy sector, and also you mentioned gold, the miners. Are there any other commodities, or mainly energy and precious metals?
If you want to dig back into it and stay really topical about what's going on right now, the prospects for copper this year are unbelievable, right? Copper is another base metal with extremely low inventories at the moment. Copper is obviously going to be a necessity in the pivot to electronic battery power at whatever pace we decide to take on, the pivot toward carbon neutral. So the demand is going to be there. And technically speaking, copper is one of the most bullish charts that I can find, Giorgio, on my screens, right? And the reason why is because it held on the pullback. We just had, when we had the commodity bull market running and we had LME copper trading above 10K, looking like it was going to go to the moon. That was sort of the peak of the carbon emissions net zero conversation and the Biden administration coming in and shutting down the oil markets, et cetera. So we came out of that peak and we had a big commodity sell-off after that, right? Copper backed off all the way to 7K on the LME. And if you look at the chart, that was the high in 2018 that copper rallied up to again, and then finally broke out from. So when a stock pulls back to, when a security pulls back, it doesn't matter if it's a stock or a commodity, but when a security that's rallying in a bull market pulls back to the previous year's highs and holds, that's a really strong signal to me. And I've been observing that since it was on its way down. I've been observing that saying, hey, 7K was the high back in 2018. Be careful, because that might be the low this year. And that was the low last year. And so now to end last year, copper recovered all the moving averages, the 50-day, the 100-day, and the 200-day. and to start this year broke out above the 200-day moving average. And that just happened yesterday. So this is after like a full year of being under pressure with a strong dollar. And now it looks like the dollar direction has turned decidedly. And we've got two central banks that punctuated the highs in the dollar index. If you remember, the Bank of England had to intervene in the gilt market when the dollar index was at its dead ball high. And then after that, the Bank of Japan had to intervene in dollar yen when it got to 150, right? They stepped in and supported the currency. So since we've seen those two central banks, the dollar has turned lower and price action is down. So last year, with the dollar rallying, that's a headwind for commodities, right? Commodities are priced in dollars, so they do better when the dollar is going down. If this year I'm correct and the dollar has turned and is going to head much lower, it should provide a massive tailwind for commodities and mostly for metals. Right. So that's another tailwind that you have in your pocket this year if you want to bet on copper. And it still tells a really, really compelling story to me. It's a subset of metals and mining, but you can play US stocks like Freeport, McMoran. You can play, XME. There's a number of different ways you can play the copper ETF. Right. So yeah, I think there's really good opportunity in copper as well this year.
Nice. And now talking about currencies, as you mentioned, the strength of the dollar, something that really a question that I have, because of course, on the one hand, you have a very strong dollar that creates problem abroad, as you said, the gilts market and the dollar yen exchange rate. On the other hand, it seems like the US economy is the strongest among developed economies. So how are you imagining a weaker dollar into this year if the US economy might be stronger than the European economy and they also have a war there? And as example, you see the DXY is 50% is the euro. So how do you see that playing out?
So I think that especially due to this war and coming out of this war, that there is going to be an extremely inflationary scenario in Europe as well. And I think that the European bond markets are going to sort of hold the ECB's hand to the fire this year, like the dollar market held the Fed and the short-term rates markets held the Fed's hand to the fire last year. I think that could happen where we see rates going higher in Europe at a faster pace than they do in the US at some point. Right. And if that happens, then you'll see far better strength there. You're already seeing breakouts in the Aussie dollar, Aussie against the dollar, which is another commodity driven currency. It could be a kind of thing where euro gets strength from the commodity markets. So it could play out in a number of different ways, Giorgio. It doesn't have to necessarily be that, the US can't have the strongest economy and also have a weaker currency. I mean, we just had a year where the dollar was absolutely explosive, right? And up at the highs, I forget what the dollar was up, but that was an outlier of a year, right? For the dollar to be trending that sharply. And a lot of this is the risk, is sort of the markets digesting the intense risk that we had coming out of lockdowns. A lot of it has to do with the treasury market finally selling off, after being pinned to the highs, for the entire lockdown scenario with zero interest rates. So, markets are working off a lot of unnatural events. And so I don't necessarily know that dollar relationship scenario is going to be as predictable as traders thought it once was. We just saw the dollar trend higher for an entire year after consolidating for an entire year. This might be a year where the dollar trends lower for an entire year and nobody really has the answer why.
Got it. And so wrapping up your ideas about opportunities, you see commodities, you see gold, you see energy markets. Do you think that the bond market could be interesting at this point? Probably in the shorter end with these nice yields, or what do you think about the bond market right now?
Well, I still think, I still put it this way, Giorgio. I've been trading the bond market from the long side down here, right? There was a massive island reversal at the lows, which is not to be ignored, right? That's where the bond market cratered and sold off really sharply. And then I think it had 2 sessions that were dangling off of the chart away from the rest of the ranges. And then the bond market rallied back from that and left that island at the bottom. So that to me looked like a good bottom in the treasury market, right? So something at least we can work off of after being down 20% last year. Excuse me. It's just been a really tricky trade to stay in. But yeah, I think that the bond market has upside, mostly because the economy is probably going to sputter along and probably not, if we're going to see weak economic data, I got to think that the bond market is going to rally on that. Especially, like you said, there's got to be some large corporations taking proper advantage of the yields that they're seeing out there right now. And it makes sense to me that we could definitely see some kind of a sharp rally in bonds. The problem that I can't get there is with my fundamental view that we're going to continue to see inflation and continue to see, attack on commodity supply and continue to see supply chain issues. So if I see all of that, it's hard for me to picture lower rates unless the economy really, really tanks. So I'm bullish bonds from down here. I just don't know how much upside there really is if I expect inflation to creep back into the picture.
Of course, it makes complete sense. And also, it's why a lot of smart investors now are bearish bonds and other very smart investors are bullish bonds. And it's all this dichotomy because you have, if you think that inflation is going to pick up again, you're probably going to expect the Fed to raise rates even higher than the market is expecting right now, which would be bearish for bonds. So this makes sense. So now for the final question, I want to tap into your experience. What advice would you give to new investors? What are the most important things they should try to develop?
Well, I think that thinking about survival every day is important, and thinking that no matter what, you're going to run into opportunities that look amazing and that you're going to want to trade and be involved in. And I think it's always just important to remember, especially for young and new traders, the most important thing in trading is to survive. Right? Like, so you should always start with a method of survival, and you should pattern your trading patterns around being disciplined, right? And getting out of losing positions and understanding that the best traders are only right 55% of the time. And so those are the guys that know how to make money when they're right. And those are definitely the guys that know how to get out when they're wrong. So I think that, you can have your book and your trading positions and all your ideas and everything like that. And the most important thing, especially if you start dipping your toe into leverage or options trading or more complicated things like that, is that you want to be around trading in 30 or 40 years, right? It's not likely that you're likely to put a trade on and ride off into the sunset and retire on it. Right. I've been trading my whole life, and even the traders that I know around me for a long time, trading becomes a career and something that no matter how you do, you always just want to be alive for that next opportunity as it comes around. And I think a lot of times that if you keep that in mind every day, that's a good basis of discipline to start off with. It keeps you humble and it keeps you disciplined with things that are losing money. When I have things that are losing money, I just get them off my pad, and I have the idea and the ability to buy it back if it becomes right again or feels right again, and make money on it the next time. And that's a skill that I've developed by trial and error. But that also feeds into some strong advice that I have about staying concentrated in what you trade. I've noticed that a lot of young traders that ask me advice have 20 or 30 positions on their book, and I say, why do you have so many positions? Do you have 20 or 30 edges in the market that you think that you found, or are some of these just guesses? And as it turns out, if you force them to whittle their book down to the places where they really, really feel like they have some kind of an edge, they probably only have 3 or 4 positions. So if you keep that in mind when you're trading as well, I think that that's a good set of core values to start out with for beginner traders.
Thank you. So, Tony, thank you so much for taking the time to be here today. It's been very interesting conversation, and I'm sure people will love it. As we close, where should people go to learn more about you and the work you do at TG Macro?
Sure. So you can go to my website, tgmacro.com. I'm the editor of the Morning Navigator newsletter, and there are samples of that newsletter up on my website. You can find me on Twitter at tgmacro, and I have a Substack page, which is a free video offering on tgmacro.substack.com. So if you want to start with the free offering there, I put out about 1 or 2 videos, short videos a week about the markets and talk about what's going on and some of my views. And then my newsletter kind of really drills into the trading side and provides a lot more background on the trades and the risk reward and things like that. So that's where you can find me. And that's what I do, Giorgio. And anytime you want to give me a voice to speak to the people of Rome, I'm happy to get on the Zoom call with you and talk it out.
Perfect. Thank you.